evening. You're watching The Money Show on ET Now. This is your daily 1 hour long dose of personal finances, where we also, of course, answer your questions and queries on your financial portfolio, your financial planning, and if you have any questions and queries on how to invest your money. Well, let's kickstart the show by telling you what we have lined up today for you. Investing for senior citizens. If you are a senior citizen or on the verge of retirement, or you would like to invest on behalf of your parents or any senior member in your family, then tune in and listen in to the show, because that's exactly what we will be discussing today. Later, we'll also be talking about Provident Fund, or the EPFO. There have been several changes that have been introduced in the EPFO, several new accounts as well that have been introduced, investing instruments as well. But what's more is that the EPFO as well has faced some music on account of the economic crisis that was induced because of the coronavirus lockdown. So that's going to be extremely important to understand that what exactly, where exactly rather is the pension fund investing your nest egg. And later on the show, in our Spend with TMS segment, we'll be talking about the big Apple event that took place yesterday. Interestingly, there was no iPhone 12 that was launched. So we will be reviewing all the products as well as several new products that have been released over the course of the last couple of weeks with Nikhil Chawla. So without any further ado, let's kickstart the show and bring on board our very first guest for today. It's Hemant Rustogi from Wiseinvest Advisors. Hemant, thank you for joining us today on The Money Show. So to start with, many a times a lot of our viewers tend to think that, okay, investing is just this process where I invest in mutual funds and maybe a couple in debt funds, and I already have my PPFs and fixed deposits as well going on. However, the common mistake is that they adopt this one-size-fits-all approach. So why, do you say that for senior citizens or for the people who are on the verge of retirement or who are already retired, why do you believe that their investment strategy, their approach to how to invest their money should be different compared to somebody who's younger?
Well, Navina, these are very challenging time for all investors, more so for the senior citizens, I would say, because they are at a stage where they can't take too much of a risk. The requirements are very different from someone who's trying to build corpus. So it's very, very important for them to really build their portfolio in a manner that, the so-called golden years of their life are where all the requirements are taken care of. Let me put the requirement of, the senior citizen in proper perspective here. One is, I would say that the golden years are actually a mixed bag for senior citizen. One, because, they have all the time in the world to do things that they always wanted to do all their life. But the problem is that the income stops, but expenses don't. So it's very, very important for them to manage their finances in a manner that the retirement corpus is able to perform the core function of providing income or supplementing their income during the retirement years. Second, the general feeling is that the expenses for the senior citizens come down after they retire. Well, I think generally you can say that, but I think it again depends on the personal situation of every senior citizen and also the health condition. So if any senior citizen has a health situation and there is no adequate health insurance, the actually expenses can go up. So it's very, very important. So I would say that senior citizens have to stay financially young to make sure that they get the best out of the retirement corpus during the golden years. So as we can very clearly see that this is a very, very challenging situation. In the current scenario where the interest rates have gone down, they have to definitely look at options where they not only get safety of capital, they should be able to beat inflation, because the requirement is not only regular income. There are a couple of other requirements. For example, they need flexibility, which means they need liquidity. They also want to leave a legacy. So it's not about making, just like you rightly said, go and invest all your money in very conservative option. Maybe this is good enough today, but as the rising costs are there for the living, they will find it difficult to fill the gap there. And of course, everyone wants to leave a legacy for the next generation. And if the investment is not done properly, you will actually see the next generation getting much lower than what you intended to pass on.
Well, that's definitely the case, and I like the term you used, financially young. I guess it's something that's very relevant as well, because expenses don't stop, but income does. So it's important that while you may age, your money should not, or at least how money keeps coming into the household. You should try and ensure that there's minimum disruption over there. However and whichever way your expense takes. So Hemant, now the dilemma that we are in the midst of, again because of coronavirus, like you mentioned, is that one of the most preferred tools, or at least I have noticed that one of the most preferred tools for senior citizens is FDs or PPF, or basically anything that will give them an assured interest return with minimal fluctuations. We are in the midst of an environment where this interest is low, whether it is for PPF, whether it is for fixed deposits, in some cases even for senior citizen, bank account, FDs, that as well is, quite low. So in such a scenario, where should senior citizens invest?
Well, I think, you're absolutely right. If you were to really analyze the portfolio of most senior citizens, you will find that the FDs actually form the core of their investment portfolio. Considering that the interest rates are very low today, I think, like I said at the beginning of the show, that it's a very, very challenging situation for the senior citizen. So I think the time has come for them to really look beyond FDs. And fortunately, there are many other options available, both in so-called traditional investment options and also the market-linked product. It has to be usually a combination of this. So considering that the FD interest rates have gone down, let's look at where they can get higher return than them. Let's look at first the traditional options, because ultimately, if you look at any senior citizen, the top priority is the safety of capital. So there are two very important options that senior citizen can actually consider. One is the senior citizen savings scheme, which currently offers around 7.4%, which is payable on a quarterly basis. And the second is the Prime Minister Vay Vandana Yojana, which is actually managed by LIC. That also offers 7.4%. Again, there is an option to get the return either on a monthly basis, quarterly basis, half-yearly basis, or on an annual basis. So if you were to really compare what these two options are offering today as compared to FD, these are certainly the better option. Each one obviously have limitation in terms of how much can you invest there. For example, PMVY, you can invest 15 lakh, but if both the spouses are senior citizen, they can invest 15 lakh each, so you can invest 30 lakh. The same is the case for senior citizen savings scheme. There again, the maximum limit is 15 lakh, but if both are senior citizen, you can invest 15 lakh each, obviously on a joint basis. So these are two options. Second thing, like I mentioned earlier, again, the important thing is to make sure that the portfolio value also grows. You're not only looking at fulfilling the requirement of your regular income, you want your money to grow even as a senior citizen. So the focus has to be at least put some money in options, the market linked products of maybe mutual funds that have the option to give you higher return and maybe help you in kind of getting a positive real rate of return. Considering that safety is of paramount importance for any senior citizen, they can begin with looking at hybrid funds. There are debt-oriented hybrid funds, there are equity-oriented hybrid funds, and there are a couple of other variety of hybrid funds. My preference here would be that senior citizen can look at equity savings funds, which usually invest around 20% in equity, and the rest is invested in arbitrage and debt. Then there are balanced advantage fund, which invests around 40% in equity and the rest in arbitrage and debt instruments. The major benefit of investing in these two is that one, they allow you to earn higher return than what you're getting elsewhere. The second is that even if you were to generate income through them, there is a very smart strategy of systematic withdrawal plan, wherein you invest in these funds and give instruction to the fund houses to redeem a particular sum on a particular date every month. So despite being invested in a market linked product, you continue to get regular income. So as you can see that this combination in the portfolio allows you to get regular income, allows you to make your money grow, and also gives you the flexibility in terms of making some changes or maybe taking out some money, which may not be there if your investment is 100% invested in the traditional options.
Okay. I want to get in your opinion also on this whole bit when individuals say that, okay, I want to, my financial goal is retirement, or I want to basically save up for my retirement. But many a times there's this tendency to look at retirement, or rather financial planning retirement, as something that stops once you retire. But I at least believe, and in the course of my interactions with you and with many other PF experts as well on the show, it's a process that continues even beyond retirement. So yes, of course, there are tweaks that you make. So let's assume that right now there's a senior citizen. He's looking at what's happening with the economic environment, and let's say he's still in the earlier age, because like you mentioned, right, you want your money to grow as well. So there would be some element of equities. Would you recommend, or equity mutual funds, let's put it that way, would you recommend then that perhaps that should be trimmed down a little because there's so much of uncertainty?
Well, I think there are two aspects clearly here. If you're talking about someone who's trying to build corpus for retirement, certainly equity has to be the mainstay. If you're talking about senior citizen who was trying to kind of generate regular income as well as trying to make their money grow, equity has to be, again, an integral part of the portfolio. Of course, you have to be very careful in terms of what proportion of your portfolio invests in equity. It may not be necessarily through equity funds. Like I said, there are many ways that you can actually start taking exposure in equity, which could be through hybrid funds, it could be very conservative hybrid funds, a slightly aggressive fund. Again, there's another important aspect to understand is that it will all depend on the personal situation of every senior citizen. For example, if there is a senior citizen who doesn't have to worry about regular income because he or she is getting pension, so the regular income needs are taken care of. So which means that they can actually afford to have slightly higher exposure to equity, because then the focus would be in leaving a legacy and making sure that the money is growing at a healthy rate. So while equity has to be certainly a part of it, irrespective of whether you require regular income or not, but the proportion of that will depend definitely on what is that you want core of your portfolio to deliver for you. So equity has to be there depending on what you need. Fix up the exposure, but like I said, it need not be necessarily through pure equity fund. It can be through hybrid equity fund. It can be, even looking at equity fund, maybe you look at index fund, maybe look at large cap oriented multi-cap funds. So there are different options in that. But I think the key is to decide how much exposure should be there in equity. And as you rightly mentioned, I strongly believe that even after retirement, some money has to be in equity, because imagine like somebody retiring at 60 and has a lifespan of another 25 years. Today, your expenses are being taken care of, but considering the long-term average inflation of 7%, where is that additional money going to come from? This is where equity as an asset class will deliver the required result for you. Of course, there are going to be bouts of volatility. It's going to test your patience, like every investor who invests in equity. Once we understand that this is the long-term potential of equity and this is what equity can do to my portfolio, I'm sure it becomes slightly easier to manage the volatility.
Very nicely explained, and I guess if anybody who's hesitant of putting their money in any sort of equity component, I guess Mr. Rustogi's answer should be able to convince you. So how much then, Mr. Rustagi, should be the equity component, debt component, or if you could just sort of break up, an ideal portfolio of a senior citizen currently?
Well, again, Mubina, it will depend really on the personal situation of each retiree or each senior citizen. Like I said, if the requirement is to get regular income, any money that you invest in traditional option, we did mention about a couple of investment options which are giving you 7.4. Even if you're paying 10% tax on that, okay, it comes below the inflation, long-term inflation level. So you're going to obviously struggle. So that will not allow you to actually decide what should be the quantum. If the requirement is not for the regular income, clearly your exposure can be even 30, 40%, even 50%. But if you really want equity to make some meaningful difference to the potential of your portfolio, it has to be at least 20%. That's the ballpark figure that I would put. But again, it depends on the personal situation. It could be more, it could be slightly less, but on an average, at least 20% has to be there for it to make any difference to your portfolio.
All right, well, there you have it. That's everything to know about investing, especially for senior citizens. If you have any questions or queries, folks, you can email us on the Money Show at etnow.tv. We will be getting your queries answered with respect to, how to invest, or if your portfolio is okay. Email us right away and we'll get your questions answered. This is our Ask the Money Show segment. So for now, let's take on board the questions that we have already received. First up, we have a query coming in from Sabu Isaac. He says, I'm actually on the verge of retirement and I have a corpus of 80 lakh rupees. Now he wants to know how should he invest this money. I think that he has not invested any of his money so far. This 80 lakh rupees is purely perhaps savings over the years. And he wants this money now to sustain through his, retirement. So assuming he's maybe 65-ish, he wants it to sustain for the course of the next 20 odd years. His exposure to the stock market, he does have some, is very, very minimum. Of course, his risk taking appetite is very moderate, and his current yearly expense is 7 lakh rupees. Okay. So, what would you advise him? He's not had any investing experience to speak of. He just has a few equities here and there, like he himself has mentioned, very minimum. So, what would your recommendation be? 80 lakh rupees. I mean, firstly, is this with a 7 lakh rupee current yearly expense, is this really going to suffice?
Well, I think what he's also estimated that he's looking at maybe generating a regular income of around 35K, right? Out of a portfolio of 60 lakh. So if you really see what his requirement is around post-tax return, because this is very important again, the tax efficiency of return is very, very important. Many senior citizens make this mistake of looking at a gross return and ignoring the tax efficiency of the return. So what really happens is when they pay taxes, then they see that
clarification over there. Just a clarification over there. This query is actually from Sabu Isaac, and he's saying he has a corpus of 80 lakh rupees. He wants to know now where to invest it. He is on the verge of retirement, so he does not have any. He's simply just saying that currently his yearly expense is 7 lakhs. So that's essentially what his question is. He wants to know how to invest 80 lakh rupees. That's the total corpus when his current yearly expense is 7 lakhs. So assuming that's roughly going to be the expense, at least for the next couple of years as he steps into retirement. This is from Sabu Isaac, Hemant.
What will happen is clearly, like I said at the beginning, some expenses will go down after retirement. Okay, it again depends on the personal situation of each retiree. If the health condition is good, if the medical insurance has been taken, which will take care of any medical expenses, usually you can expect that your expenses will come down to around 60-70% of what you were spending before retirement. So if you look at in terms of what he needs to raise is around 7% post-tax. Now, let's see how he can get that. We talked about safety being very, very important because this is all that he has, and he has to make sure that the corpus that he has created lasts till his full life tenure. So clearly, if you look at from the safety point of view, two instruments that I mentioned earlier can be considered. One is Senior Citizen Savings Scheme. The second is the PMVVY. Both are offering 7.4. So these are two options which definitely have to be there. Some part of it can be in FD because you also want some flexibility and some liquidity. And the remaining, I would say, again, how much should go into that will depend upon two things. Like I mentioned, if both the spouses are above 60, they can put 15 lakh in their names. If not, then he can invest maximum of 15 lakh in each. So 30 lakh will go there, maybe around 10 or lakh odd amount he can put in FD. The rest he should consider a couple of hybrid funds that I mentioned. For example, I said equity saving fund, where you can consider Quota Equity Saving Fund. The fund has a tremendous track record over the years. Then there is also Balance Advantage. There again, as I said, around 40% can be invested in equity, and the rest is arbitrage and debt. So a combination of these four. There is another option for him is also Post Office Monthly Income Scheme. And the reason why I'm not recommending to him is because it's offering 6.6% right now. Here again, he can invest 4.5 lakh each in his name and the spouse name. But considering that that is taxable also, he may not be able to actually fulfill his requirement there. So I'm looking at on traditional side two options. And on the market link product, as I said, equity saving and the balance advantage. If this is how he divides his investment or builds his portfolio, he will have enough flexibility, liquidity, the potential to make his money grow. and get, like I mentioned again, he can also look at opting for SWP for the mutual fund investment and fulfill his requirement of whatever his requirements are, 6 lakh or 7 lakh, depending on what his other expenses are going to be after retirement.
Okay, well, there you have it. That's the recommendation coming in from Mr. Rustagi. All right, let's take our next question, and reminder to our viewers, you can email us on themoneyshow@etnow.tv with your questions. Shivakumar Burli writes in saying, I need 35,000 rupees per month. He currently has a corpus of 60 lakh rupees. Now he wants to know, how should he plan? He's not exactly mentioned his age, but let's assume like Sabu, he as well is just about on the verge of retirement. Now his corpus is smaller. It's roughly about 60 lakh rupees. But then again, his monthly estimated expenditure as well is a little smaller compared to Sabu's 7 lakhs per annum. Shivakumar's is 35,000 rupees per month. So that roughly comes to around 4 lakh rupees. I don't know if he's underestimating his expenses, but this is what he's written. He's got a corpus of 60 lakhs. Would your advice be any different, Mr. Rustagi?
Mobina, you're absolutely right. I think we have to assume that this is all the money that he has because we don't have a detail of any other investment. Considering that he's looking at raising around 35,000 rupees per month to meet his expenses, he will again require around 7% post-tax. So I think even for him, I would recommend exactly the same combination because while he requires 7% today, every year considering the inflation at 6-7%, his monthly expenses are going to go up. So he has to make sure that the portfolio has enough flexibility and also enough exposure to market-linked product, which allow him to keep pace with the inflation. So I would recommend exactly the same combination of product for him. But obviously the quantum will change depending on the corpus because there it was around 80 lakh, here it is 60 lakh. But otherwise, I think the portfolio composition has to be exactly the same.
Okay, well, that's the recommendation, Sabu, coming in for you. Let's take on board our next query coming in from Aman. He says, my goal once again is retirement, and my retirement right now is still around 10 odd years away. He said he's already got his SIPs going in roughly about 6 mutual funds, but he wants you to check in category wise if the categories as well within the mutual fund basket that he's selected are good enough. So there's Axis Multi-Cap, SBI Focused, where he's put 10,000 each, Murray Focused Fund, 15,000, DSP Equity Opportunities, 10,000, Tata Large and Mid Cap, 10,000, and Invesco Small Cap, 15,000. So lots of focused funds. We've got 1 multi-cap fund, 1 small cap fund, and then 2 large cap funds. Additionally, he's saying that he has another 10 lakh rupees that he can invest as a lump sum as well. He's wondering, by the way, if he should be also having 1 mid-cap fund. But yeah, 6 funds, Mr. Rustagi, retirement 10 years away. And yeah, he's roughly got 70,000 rupees per month being invested in these funds, plus another 10 lakhs that he can invest. What's your recommendation?
Well, Mubina, 2 important things here. One, he's talking about building a corpus for retirement. And as we all know, retirement planning is one of the most important goal for any investor's, financial life. The time horizon, he said something around 10 to 15 years. So let's assume for a moment that he has 15 years for him to build this corpus. To build a corpus for retirement over the next 15 years, investing through SIP and equity fund is a wonderful strategy. And I think he's bang on there as far as the strategy is concerned. But I think it's very important to remember 2 things for him. One is that he has to continue his process uninterruptedly. But there are going to be occasions where the market will see volatility. There are going to be fears in his mind where he will wonder whether he should continue or not. I think he needs to keep his focus on one important thing, that over the longer period, the equity will give him a better return. Second is the fund selection has to be good. When I talk about fund selection, I'm not talking about the top of the table kind of fund. I'm talking about funds that have the potential to perform consistently above average if you were to compare with the peer group. So, and of course, that can happen only also when you have the decent exposure to all 3 market segments, large, mid, and small. But my recommendation always is for investor who is building a corpus for retirement, the bias has to be towards a large cap. I would actually recommend a couple of changes here. The multi-cap fund, I'm not saying right now, because as we know that SEBI has come out with the new guidelines, we really have to wait and see what really happens in that. what happens to excess multi-cap, whether it'll get merged with some other fund. So we really don't know. So couple of funds which I'm basically recommending. He can look at Axis Focus 25. He can put 15,000 in that. SBI Focus, he can put 15,000. So 30,000 will go in these two funds. Then I'm recommending him two large and mid-cap fund. One is the Mirai Asset Emerging Blue Chip Fund. He can put 15,000 there. And the second one is Kotak Equity Opportunity Fund. And I'm also recommending him one Contra fund, which is Invesco Contra, where he can invest around 10,000. So I think to begin with, these 5 funds should suffice. He also has to remember one thing, that his commitment over the next 10 to 15 years to the asset class equity, not to these funds. So he has to monitor his portfolio. He shouldn't be hurried in making changes, but make sure that keep an eye whether they are performing consistently or not. So if he does that, I think he should be able to achieve a corpus of around 3.5 crore. You also mentioned about 10 lakh as a lump sum. Considering that his time horizon is 10 to 15 years, considering that he is investing a very decent amount through SIP, 70,000 per month, which is 8,40,000 in a year, he can invest 10 lakh in one go. He need not do it in a phased manner because his SIP amount will allow him to average it properly. He can consider the same fund in the same proportion to invest this 10 lakhs.
All right, well, there you have it. Those are all the recommendations coming in from Hemant Rustogi for your questions and queries that you've sent in. Mr. Rustogi, thank you for joining us today and, sort of giving us a whole 360-degree perspective, especially for those senior citizens watching right now on how they can invest. Okay, well, on that note, we will take a very short break right here on the show, but we'll keep the theme with retirement and saving money for your retirement, EPFO. That's where all of us, especially salaried individuals, have been depositing a part of their salary. The most recent news, of course, was with respect to the interest now being credited in parts. Why is that happening? Should you, as members of the EPFO, be worried? Find out after this very short break.